play IT manager for 2 hours.
Good. Okay, well, welcome everybody. This is our 10th Michigan Investor Group meeting, which sounds kind of good. Thank you very much for coming. Tonight, as you're aware, we're going to talk again about the topic of high cash value life insurance and some different ways of using that to, kind of become your own bank. First off, I'd like to share a couple things. I'd like to talk about our next planned MIG events, and then, of course, give a little intro of Gary. And before that, I'd like to ask who's here, who's a team member of Orbit Form, if you'd raise your hand. So all on this side, Jake and Mark and Phil and Sarah, Brian somewhere, I think, in the back. I just wanted to mention that, one of the reasons that we can do this is because of people like this team and other team members here at Orbit Form. And just wanted to say thank you and for helping us, have a place that allows for these kind of meetings. All right, so we should be wrapped up by 7:30, and this is a casual place, so if you want to get up and get some more water or a snack, please feel free. Okay, so in February, we're going to have a speaker talk about cryptocurrencies, and the specific kind of overview is going to be not so much how or what they are or why you want to invest. It's why you want to pay attention to them, and like a little more behind the scenes, and a little more background into why you might want to learn about them and pay attention to them. Not just what they are and how to invest in them, but why you might want to learn. So that'll be February 19th, and start getting those emails out here pretty soon. And then it'll be a couple months, but we're going to have another real estate private equity group presentation, and then I'm still hoping to have private equity group that deals with buying operating companies present later on in the year. And we might even have, hot off the presses, I got some good news today, but we might have a group come in and talk about automated check cashing machines. So think about that for a while, but that's going to be an exciting one. So I want to give a little introduction of I guess my journey with this becoming your own banker, high cash value life insurance process, and why we're doing this round 2 of this topic that we kind of discussed back in August also. So this is our first returning guest and our first returning topic. And after our August MIG meeting, several people over the last couple months have been asking, can we have another round of this life insurance discussion? Probably partly because of interest and partly because of confusion. But so we did a little survey, and we got 24 out of 30 respondents said, yes, please, let's have another meeting. So that's why we arranged this, and Gary was gracious enough to return and spend time with us again. So a couple years back, like in maybe early 2017, through some of my research and listening to different, investment-related podcasts and real estate, leaders, I kept hearing about this becoming your own banker concept, or a high cash value life insurance concept, and I kind of ignored it for a while. And then later in that summer of 2017, I started looking into it a little further, and I kept trying to figure out what was wrong with this, or what was I missing, or what was maybe the scam or something, and I couldn't find it. And I just kept meeting more people who were using life insurance in different ways than just risk management or death benefit. They were using it as a way to, for the ways that we're going to talk about tonight. They were using it to have an efficient savings vehicle, to have access to capital, to have a compounding, uninterrupted compounding place to store your capital, some tax efficiency, a place to put your money away that's tax efficient. And I think it was that efficiency that really grabbed my brain. That's what really kind of grabbed me and said, wow, is there really something, can I really accomplish several objectives by saving the same dollar in one place? And I believe you truly can. save your money in life insurance, have it grow tax-free with compound growth, still be able to access it, and all the time you're protecting your loved ones in the event of a premature death or catastrophe. I know that sounds like a lot, but that's what got me really, once I believed that and understood it, that's what made me feel so passionate about this topic. So I eventually, through all the research, determined, yes, it was possible to achieve all these objectives. And just to summarize it, I think I said this before at last meeting, if there was only one thing I could have learned, a new financial mindset or a new investment feature or a new asset class, this would be it, because I believe this is the best foundation, and everything else you're doing can just be improved by having this as your financial foundation. Okay, so what does good look like for tonight? Again, we're trying to create some awareness of this topic, maybe create a little interest in the topic, and it'll be a big win if some more of you who already have want to learn more from Gary or from me, or want to get some books, or that'll be a big win if you just take the next step to learn more and see if it makes sense to yourself and your family. So, Gary Pinkerton. Gary is married to Sue. He has 2 teenage sons, one high school, one in college, Jake and Ryan. He's going to talk about his background a little bit, but from Illinois, now lives in New Jersey. He's been a wealth strategist and life insurance specialist with Paradigm Life for 8-9 years. And some of his investing experience is in owning rental properties. So he has a lot of experience in that, and more recently he's started investing in other things as well. But that's kind of the foundation, was real estate and rental properties. Gary's a retired U.S. Navy captain, and with 25 years of service to the USA.
Thank you.
Thank you. So I was sitting down with a trusted friend of mine, and this is back in 2017, and I was just to the point where I thought, this seems real, and I asked him, I said, have you ever heard of using life insurance, for building like your own bank or personal finance, and he just looked at me and said, you got to call Gary Pinkerton at Paradigm Life. And so that's how I got introduced to Gary. And that was after interviewing and working with many different life insurance advisors, trying to learn this concept. And after all that, decided to ask Gary to help my family and my extended family. That's why we're here. So please welcome Gary.
Thanks, David. Very warm introduction. And I was mentioning in the back that I've spoken a lot to places, mostly in the Navy, not out of the Navy, but I always get nervous. But it's very nice when you're in a warm environment with people you've met before, many of people. So it felt a lot today when the moment I walked in the building, like it was kind of coming home for Thanksgiving or something. It was really, really nice. So it was good. If you've ever done a PowerPoint presentation and the formatting's been wrong, it's always kind of questionable about what's going to happen, right? So one of the things I didn't do in a busy day today was actually come dry run this, other than making sure the clicker worked with David. But I didn't write this with this word down here, so every picture on there might be really, really messed up. So we'll see how that goes. But one time in the past when I did one and the font was off, just because of dimensions of the screens or whatever, it was a mess. So we'll see how it goes. Okay, a little bit of logistics, if you would bear with me for just a moment. I did this last time too. How many were here last time before I get together? Okay, so, and some of you got a book that I participated in, and I like to give this one out. Mine's like 5 pages, so it's not a high barrier to entry. But it's a group book, and there's a lot of inspiring stories in this book. And I gave out some to that I had enough to carry, room to carry. I had room for this time too, so I brought 7 or 8 more of them, and they're in the back. And so feel free, please, to grab one if you didn't have one already. I also have a digital copy, a PDF copy that you can get by put your name on here in a moment. So I'm just going to pass this back. Anybody who doesn't have one that would like one, it's all yours. There's more in the back. So then last time when I was here, I passed this around. I'll pass both of these around, but it goes just to my website, and if you enter your information here, you can get Patrick Donahoe's book, that one, and I think there's one other in there, like an audiobook version of it. So just play with them so they don't go silent on you, so I don't have to come back, but you can kind of hand them in different directions. Okay, enough of that. And then David asked me to not move from this spot, which I've already done like 3 times, so you guys remind me to come back here, because I wander just a bit. So I thought I would throw you completely off right at the beginning. So this is a slide that I was not intending, the first few are something that I was not intending to talk about here. It's about how do you use life insurance, how have the wealthy in America since the 1800s used the life insurance coupled with a good education program to prevent loss of their wealth, to propagate wealth for generations in their families. And life insurance has been a core cornerstone with that. Life insurance trusts and education, family education about finance since the early 1800s. So I wasn't going to talk about that, but I did a presentation 2 days ago, and it was a webinar kind of thing, and it was a multifamily investing group. I don't even know how many people were there because it's one of those things about webinars. It could have thousands, it could be one other person. But in leading up to it, they said, give us 3 topics and we'll choose. And so I said, well, I know this is people who are raising funds for multifamily properties across the country and then investors interested in doing it. So I said, it was a topic about how you can use this to help fund your investment and how you can use it to store capital needed when you're raising other people's money to buy the property. And then I had a throwaway, which was how to prevent the loss of your family's wealth from taxes and family. And they said, oh, please choose that one. Everyone said that. So every time I almost talk about this topic, they say, go back and talk about that. Let's talk life insurance later on. It's just this resounding thing that most of us who have kids want to talk about. At some point, we know we're a little bit, we're probably a little bit short on where we want to be there. And I have for years, one of my fears has been that if I make too much money, my kids will become very comfortable and kind of entitled, and I'll have that kind of rich kid, and I won't have somebody who's very hungry like I was because I grew up really, really, kind of dirt poor. So I'll talk about that in a moment too. This thing echoes to you. It's kind of interesting. It's like you have a microphone in your face. Okay, so taxes and family. Why are they the biggest stealers of wealth? Well, let's go to taxes first. So these guys, who can tell me the gentleman on the left? All right. Commodore Cornelius Vanderbilt. So he was, they called him the Commodore. He was the guy who basically created all the transportation around New York City and then created most of the railroads. He was the wealthiest man in the early 1800s in America at today's numbers around 120-some billion dollars. The gentleman just to his right is Andrew Carnegie. He upped the game for Vanderbilt, and he was pretty close to 175 million. And then the guy on the right, anybody? John D. Rockefeller. Yeah. So Rockefeller is still the wealthiest person who's ever lived in America. About 250 billion or so, something like that, personal wealth, not his company's stock price. So very wealthy individuals. And then there's family. So I don't have anything against Miss Hilton, but she's just a very famous figure. She's actually doing pretty well with business right now, but she had kind of those questionable years that I think that I think Mr. Hilton, great-great-grandfather, probably didn't envision would be what his money was doing at the beginning, right? So those are, so taxes have destroyed the wealth of 2 of the 3 people in the top. Just generational use of taxes, or taxes weighing on their family. And then there's if taxes don't get it, family will. If you don't educate them well, right? So Anderson Cooper is a descendant, the only one any of us know of, as far as I can tell, from Cornelius Vanderbilt. Only one. And he had to beg and plead and try about 6 times to get on the television. It was not anything that the Vanderbilt name got for him. I don't know any Carnegies. Do you know any Carnegies? They had a couple of, 20 years ago or so, Carnegie Mellon University had this reunion, I don't know what the year was, but a large anniversary reunion. And there were almost 100 descendants of Andrew Carnegie, and not one of them had $1 million. Now, some of that is kind of on purpose. Andrew Carnegie he was like the first philanthropist in American history that went big time into the idea of trying to give away your money, kind of like what you see Warren Buffett and Gates do today. I mean, some pretty impressive stuff. So some of this, he built all the libraries in America, right? He built a couple of universities. So he did a lot of stuff with his money. He kind of gave it away, really with the thought, when I read his biography, the thought was to not ruin my children, like make them kind of earn their own, because there's some value in that. But John D. Rockefeller has a successful family, 6 generations, one of the most prominent buildings in New York City. They gave away hundreds of millions of dollars every year. And so when Carnegie says, he who dies rich dies disgraced, I get what he's saying, and he took the path of making sure that I don't die rich. But again, John D. Rockefeller's family has done some amazing things, and they have a tremendous education program, and they continue to give away millions and millions. So I don't personally believe he died disgraced. I don't think a lot of the wealthy families out there today think he did, and they're going hard at this idea of educate my family well, put structures like trusts and tax things in place, and continue to propagate your ideas, to future generations. So, okay, who am I? Enough on that aspect of it. But one of the reasons I brought those guys in is because I kind of feel like Andrew Carnegie when I read his book. At age 14, he was helping feed the family. He was working full-time. That's kind of like where I grew up on the dairy farm in Illinois. It was in the 1980s, extremely high interest rates. We had loans at 18%. And then we had 2 advisors that would always come into our life. I told a little bit of this last time, but the banker would come in and he would reduce that interest rate down to like 14%, and then we would get a little money out too. And so it was a breather that we needed. But the next year it would go up 2 or 3%. The next year, and the teaser rate would go away, and we'd be right back in that mess. And eventually, after about 3 cycles of that, there was just no way to feed the monster. So we needed to sell the farm. We had 6 months, and there was this beautiful young family with a couple little kids that came and bought the farm, and we were excited. They were excited. We had our auction, sold everything, and then they showed up a week before when we were boxing things. Literally on a Sunday, we were boxing stuff. They show up, and they had lost their loan because their money, the down payment, was in the stock market. And so I kind of have this shudder that occurs when I ask people, when I'm looking at their financials with them, where's your emergency savings? Like where's your fund in case something happens? And they say, oh, it's in my safe stocks. And I'm like, all right, well, you need to meet this young family that I met when I was a young guy, because there is no such thing in an investment, any investment. Real estate, that's not a safe place to put your money, but it is a great investment. So the other reason I put these up here is to show that I did have hair one day, and a cool car. But just to the left of that cool car is a trailer. So I grew up trailer trash, I think is the phrase we use, right? So that's why I do love trailer parks, and I'm very proud and recognize their value. We had a farm, we had a house on a family's farm there. And the top left is me on my dad's shoulder at Redstone Arsenal in Atlanta, and in Huntsville. And the reason that one's there is because this taught me something a few years later. So I went to the Naval Academy because I didn't have money to go anywhere else, and that was free. And I happened to get in, and everybody told me it was a good idea, so I went. I didn't know anything about the Navy, but I learned, and it was a good opportunity. And for 25, almost 30 years, I was climbing that rat race, right? Of get a better job, beat out the next guy, get a really good performance evaluation, get higher pay, because what I really wanted was not to be poor again. And then after command, when I had one of the most incredible experiences of my life with a crew of guys that I will never forget any of the memories, and I think we did some amazing stuff. I'd all but worn out my relationship with my wife. My kids didn't really know their dad. And I remember the picture in the top left, and I started to think about that legacy thing again. And I believe that's what's really important is not the money we pass to our kids, it's the education we pass to our kids. And those of you, Jeff, who have your kids here tonight, I would definitely want to commend you for that. And I think that's more important. I just really, truly believe it's more important that we pass to our kids what we've learned, our experiences, than we pass any money. In fact, if you pass money with no education, you might as well give them a weapon, right? So just a little piece of advice. So that's what I focus on full time. It's the main reason I left the military, because I wanted to get more time around my kids and actually do what my dad did. So we were dirt poor. My parents did not give me anything of any monetary wealth, but I was around my dad nonstop because of where we lived on a dairy farm, and I couldn't play football like my buds. I was, making hay or something. But it gave me time around my parents, which is extremely valuable time that we don't realize until we're in our 30s or 40s, but it's really important stuff. So the book that the sign up that I passed around has Patrick Donahoe's book in it, and options for a couple other ones that I've written. And the reason I put it on this screen though is that in Patrick's book, Heads I Win, Tails You Lose, there's a pyramid. And I'm going to talk about this because it has a foundation piece to it that David talked about a few minutes ago. And this was kind of an eye-opener pyramid for me. We've adapted this thing from Maslow's hierarchy of needs. And so on the bottom of his, he's got food, shelter, clothing, right? And on the top, it's self-actualization and thinking big, deep thoughts. At the bottom, though, it is the most important aspects of it. So if you take that to the financial life, what I believe is that the bottom is that foundation that David mentioned, and it is savings and protection. Like if you can protect yourself from loss of income for a period of time, and you can protect your family from the loss of the important things in their life, like you, the thing bringing most of the money into their world, or loss of your home from insurance. So the protections are the insurances, and the savings is just a liquid place to store cash for unexpected events. So the product that I use, which is high cash value life insurance, in my world and in most of my clients' worlds, fits that whole bottom thing. It doesn't provide car insurance, but really replacing the car as compared to replacing $150,000 or $200,000 a year in income kind of pales in comparison, right? The one most important asset is there, right? And it's not graduating college. That could be very helpful, but it's about investing in yourself and recognizing that's the most important asset financially in your family's future. So this pyramid, the premise is that as you go higher in this pyramid, you take on more risk. And the reason is because on the left-hand side, you have less control, less insight about what's going on. It's not about the investment, it's about your involvement with the investment and your knowledge. So here's an example. We'll take a house, just a single family house that's next door to yours that happens to be a rental, right? That house you could own, and then you would know when problems occurred, and you would have these conversations about should we replace the roof or just patch it, right? So you're involved directly, and therefore the level of mistakes and risk is fairly low. You could sell it to your buddy, but or you could hand it off to somebody else to take care of, and maybe you just an investor in his property. Well, now he might make decisions you don't like you may wake up tomorrow and it's painted pink and no one will rent it, right? So there's a higher level of risk, but it's the same asset. And then you can go to the top where some hedge fund buys it. And you have no idea what they're doing with the money or what their plans are for the future, right? So it's not about the asset, it's about how involved you are on it. And so it is my recommendation that every time you think about an asset, think about where is this in my pyramid and where am I physically, personally operating right now? Like if you have no emergency fund, and when I'm talking to a client and they have no emergency fund or their emergency fund is in Bitcoin, and they say, I would like to, what do you think about investing in X, in a rental property or whatever? And I say, you have no foundation right now. Like no investment is worth the risk of not having a foundation underneath it. So I put everything through this now that I've understood and learned this, and the number one asset being yourself. So should I invest in going to a seminar, or should I save that money to put in a rental property? I go to the seminar every time, because it's going to the tenfold, 20-fold. And the business is obviously an extension of you, right? So the Shirkeys have built a fantastic company that in this economy and with their expertise is generating tons of income. But it's because individuals, a few key individuals, are adding their value, their expertise to that business. And it's the right business at the right time. That helps. So then there's investments, right? Directly owned investments are pretty solid. And then you can look, once you've filled out that level, you've invested in yourself and your career and your ability to provide additional income, your business maybe if you're interested in that. But once that level's full, then look at the next level, right? But I still wouldn't be doing Bitcoin if I'm not a professional mining Bitcoin. And it's just it was just a good piece of advice or a tip from a buddy or some stock or share or something. I would first fill up the levels below it. And then speculation, I put the market there, but it could be anything. Again, it could be that same house again. If you have no involvement and no understanding or expertise, or not expertise, but no understanding and no involvement of what's going to happen, then it's kind of gambling. You're really pulling the old roulette wheel to see what's going to happen. And so again, we're at that foundation level. And this is just another kind of view of it with a few names stuck in there. I've gone over those. So different things that might fit in the levels of the pyramid. To give you an idea, the WMA thing, wealth maximization account, that's what we call high cash value life insurance at Paradigm Life. And so I see that really filling, again, the most efficient place to save and grow money, and then providing protection for the number one asset, which is us, the humans that are making all this happen. So in building a foundation, build a pyramid, build a foundation, focus on that first. If it's not solid, you're wasting your time on the levels above. I'm going to use some numbers this time because I didn't last time, and I felt like some people are here because I promised I would the next time. But I will hesitate. There's a bunch of numbers in the backup slides, and if we get to backup slides and everyone's really interested, I'll go into those slides. But I won't go too far now because we'll get like one more slide. There'll be a bunch of numbers in the pictures, and we all get stuck, and we're on that slide when David waves at me to finish up. So this person, though, throughout this whole thing, if we get into the backup slides and everything, it's going to be a 42-year-old individual. It's going to retire at 65, current income 150. I just said that he'll get pay raises at 3%, and he has 100,000 currently sitting. And he's got an ability to save the money at 6% somewhere. All right, it's not a savings account. It could be life insurance. It could be just a private lending with a very good source, something like that. Okay. So number one asset, we just talked about that. So I just want this to kind of sink in. If you're starting at 150 today, you're going to work for 30 more years, and you're going to get a 3% increase. That's $4.8 million that's going to flow through your fingers in your lifetime. See, a lot of people always see the Publishers Clearinghouse commercials where the guy shows up with $5 million, and they're like, oh my gosh, this is amazing. I can go buy Lamborghinis and stuff, and they blow it all, right? But it's because they don't recognize that same amount of money is going to come through their life. Like if the guy who was going to hand the Publishers Clearinghouse check said, oh, by the way, you got to sign this thing, which says you can never work again, they would treat that check differently, right? But it's the same. The amount of money that's going to flow through your fingers is huge. It's a question of can you keep it, and will you spend it in an appropriate place, right? And if he could grow it, it would be $10 million, but then he wouldn't eat for that period of time. So I recognize there's some expenses that flow into this. Okay, so a little quick lesson. There's 3 buckets of money in life. There is pre-tax money. I call that Congress's playground. I say that because it's the place that always gets the rules changed, and January 1st of this year is a beautiful example for me. The Secure Act came out, and they said, hey, for all of those inherited IRAs, you now must distribute them over the next 10 years. And I'm sorry that you're in your 40s and 50s now that your parents passed away and you're in your highest earning bracket, but now you're going to pay a lot more taxes because you're dumping this on top of your highest earning bracket. It's a fairly tough time for next generation to pay for things. Why did they do that? Because the president and Congress said, let's take tax breaks for these people and these people and these people. And then like Willie Sutton, the famous bank robber, when they asked, why do you rob the banks? And he says, that's where the money is. I mean, why does Congress go after qualified plans? Because there's 60-some billion dollars and nothing else comes even close, right? It's where the money is. So I call it Congress's playground because I believe that it's always going to change. Okay, then there's post-tax dollars. So this is like your savings account, your brokerage account, something you've paid money, you've paid taxes on the original capital, and you just pay some version capital gains on the rest of it. And so the growth is the part that's taxed. And then there's tax-free. So this could be Roth IRA. Again, I go back to that's Congress's playground, so I don't include that one here. I just put life insurance here because the rules haven't changed on this stuff. It predates the tax code. Yes, there was a little bit of a limitation placed on the Rockefeller types in the 1980s, but that's very easy to play within those bounds and grow wealth very easily. So if you take out $80,000, my point is that you have a lot less to spend on if you're paying taxes on it in retirement or whenever you want it. There's more in the middle account, but there's 100% of it if you're taking money from a tax-free account. So there's a couple of really good books out there. One of them David just gave me to look at, but another one is called The Power of Zero. And it's this idea that get your money while you're in your working years and you have income into an environment where it will grow and stay tax-free. So this is just to think about. There's different buckets, different places, and which one do you want to fill? Which one do you want to teach your kids to fill?
So this picture, this is assuming you've already capitalized your life insurance system.
Yeah.
Pulling income out of it.
Well, Yeah, this is when you're in distribution mode. Yeah, so you're going to, throughout your life, going back to here, there's a lot of money. There's a lot of money that's going to come into your world, and where are you going to put it, right? Where do you want to store it? So if we're in this thinking process, or maybe we're really young and we're thinking, okay, I'm just starting out, where do I store the money, right? Or I'm teaching my kids, where should they store their money? Well, there's some things to think about. Now, this 50 versus 80, this also assumes a really high tax bracket. So maybe you're not in high tax bracket when you're in distribution mode. That's fair comment. My point is, big picture, there's an impact on where you decide to put the money. Okay, so the foundation. The foundation is about growing savings or having savings. So I went and took a look at the different reasonable places, or at least a few of them, where you could save money. And so on the rows on the left-hand side, you know, a lot of people will store money in their home, and they have a line of credit against their home, qualified accounts, savings accounts. So if you were designing this from the scratch, from the start, these are the kinds of things I would look at. And this is why, when I started looking at future dollars, where would I put my money? And in 2011, when I learned this, I stopped my 401k contribution, I stopped my kids' 529, and I started putting it all into life insurance. And I've pretty much done that ever since, because of the four things on the columns on the top. Okay, so a great guy who's doing wonderful things in the financial services industry named Dave Ramsey. He works with a clientele that is not in this room and that I don't normally work with, and he does tremendous stuff for them, and I thank him every day for it, because I don't feel like I would be the best working in that environment. And that environment is helping people get control of their bad habits, and it gets them from a debtor, somebody who's getting overcome by the power of compounding interest. He talks a lot about the power of compounding interest in a negative term, right? And he says you got to get compound interest out of your life. Live a cash-only life, right? And that's a great first class. The problem is no one goes back to graduate school. No one goes back and figures out, is this what the wealthy and the successful for generations do in this world? It's not. It's not what they have ever done. They start there and then put the money to work. And so if you can figure out a way to have power of compounding working in your benefit, not against you, then you move to the picture on the right, and you can access your dollars without stopping the compounding. That's the big picture about personal banking or infinite banking. Another kind of big picture about this, you can do this with anything. Infinite banking does not have to be high cash value life insurance. You can do it in a savings account. You can do it with a box in your backyard or under your mattress. It's simply a way of taking cash that you've accrued, you've collected, and using it as collateral and saying, Jared, would you loan me some of your money? I'll let you watch my money as collateral, and then I'll pay you back over time, right? So I'm accessing the value of my money without using my own money. That's really infinite banking. The problem is it doesn't make any sense to do it with most things out there. It doesn't make sense to do that with a savings account. You could walk in today, Phil, to your bank and say, I got $10,000 in my savings account. I'd like to borrow money from you, and you guys just identify that as a personal credit collateralized loan. And they would do it. But you're making 1% and you're paying them 6%, right? That doesn't make sense to do that. But in life insurance, if you can earn essentially what you're paying on those dollars and earn it on all the rest of the money and get compounding in your benefit, which is a big part of it, then it starts to make difference. So just shifting to the right-hand side and having compounding work for you is one of the big aspects of it. Okay, so this is $1,000 a month saved for 20 or for 30 years. In the red, it's saved in a savings account. In the green, it's saved in life insurance. And then once you get to a point, 5 years or whatever that is on there, then 4 years, then they access the value of the dollars to do something with it. With the red one, they dump it out of a savings account and then start the $1,000 a month building it back up. On the green one, they didn't do that. They accessed the money by borrowing from somebody else and continued the $1,000 a month into their account. In the green version, it grows compounding for 30 years without impact, and it turns into $1 million. In the red version, it's, I don't know what that is, but it's smaller. It's smaller. Okay. Yeah.
So like, with this illustration, you're often this is used for like financing your vehicles.
Yeah.
So the red are, you're saving money for 4 years, which is smart, and you're buying a car with cash.
Mhm.
You're back to zero.
Very good.
And you're saving money again for 4 years, you're buying a car, you're back to zero. And what Green is illustrating, if you're saving your money in a life insurance policy, and at the end of 4 years, you're taking a policy loan, and you're allowing your cash value in the policy to continue compounding, right?
Right. Right.
So you're still buying a vehicle every 4 years, but.
Right. You're doing the same thing. It's just a matter of what are you doing with your own personal cash. So if you save money in the savings account and dump the savings account down, right, then you're starting to build it again. But somehow, so you're putting the dollars back in the savings account. If you borrow money from the insurance company, you got to pay them back, right? So there's the dollars that you're paying back to the insurance company, and that would come up out to be the same money you see in the red here, right? It's the same dollars that go back in. So if you double the red, right? So sometimes when I show this, people will say, well, but what about the money you had to pay back to the insurance company? Well, it's the same as the red. You're doing the same thing that the guy in the red is doing here, right? So you double the size of the red, and it still pales in comparison to the green, right? It is because there's no compounding. Every time you dump the money at the 4-year point to buy something, you've gone back to zero on saving, right? I saved for 25 years, 25% of what I made because I grew up in a trailer and I was bound and determined to be wealthy and not have my kids, show up to school in the clothes I showed up in. But what I didn't recognize is that I would save and then I would spend it and start the compounding curve back over. And so 25 years into this, I'm like, I don't have a lot of money. Why is this happening? Because I was well down this path right here, right?
Quick question, so following the green path then, you would be paying that back, but you're also still making your premium, correct?
Right.
Yes,
Well,
or-
yeah, if you get into life insurance, but let's say the premium's $1,000, right? So this is all, it's putting the 1,000 into life insurance or putting the 1,000 in the savings account.
Okay.
Yeah, just trying to keep the dollars equal. Great question. Okay, so one question I frequently get is, if I take $50,000 and put it into my savings account, into my life insurance policy, and then get a $50,000 loan from an insurance company and have to pay them 6%, and I'm making 6%, and the numbers are actually about 5 today, but that's what's on the sheet. So I'm going to pay them 6, and I'm going to make 6. Why does it work at all? Right? And again, it goes back to the fact that if you put $50,000 in the savings account and $50,000 in life insurance, and you dump the savings account to make the purchase, would you agree that you got to make $1,000 payments, or you got to make payments to fill the savings account back up? All right. So those payments are equal to what I'm giving the insurance company. All right. So I'm either making payments to fill my savings account back up, or I'm making payments to the insurance company. Often I will get the question, but if I use my own money, I don't have to make any payments to anyone. Well, it's true if you're shutting down all your savings accounts for the future, but most people will refill the thing. And that looks like making payments into my back to the insurance company. So you have the same amount of dollars to refill those tanks, right? The difference is that the fact that I didn't empty this one at all, it had compounding acting on it for this 25 years. So while I'm paying back the insurance company, I'm paying them an amortized loan, and my amount of money that I paid them over 25 years at 6% is $46,645. At the same time, just use a compound interest calculator, and $50,000 over that period of time turns into $214,593. Or, because I didn't use my own money, I had to pay an insurance company $46,000 in interest and made $164 at the same time. Same interest rates, right? No magic there. The reason that I'm paying so much less is because I am paying down the principal of the loan to the insurance company, right? It's an amortized loan, right? Okay, questions on that? Let me stop here because this does actually have numbers. Okay, all right.
So your interest expense that you're being charged, every time you make a payment, you have less principal
Mhm.
that your interest expense is being computed against, but the 50 grand in your policy, every time the policy interest is credited to your cash value, you have more money in it.
Mm-hmm.
So you have a continuously decreasing loan due with less interest expense, and you have a continuing increasing cash value, which is earning more interest over time.
Right. And this assumes that the only money in this discussion is equal dollars. It's apples to apples of these dollars. But I can tell you this from somebody who's got 10 of these in my life, that the moment you have these things, you use them. So I'm storing emergency money there. I'm storing money for an upcoming down payment, an upcoming vacation, tax return, tax refund, whatever. It goes in there, right? So there's a lot more money in this thing, growing and compounding at this rate than what I'm using for the investment at any given time. So it's a lot bigger difference than this, but I wanted to show exactly the dollars, because one of the biggest stumbling blocks that clients encounter, and I encountered this for the first 2 years that I was operating this before I became an advisor, was just that. How can I pay 6% and earn 6% and somehow make out big? Like, this guy's doing something he's not telling me, right? Like, he's telling me half the story. I know he is.
Hey, Gary.
Yeah.
So on the green, then, God forbid something happens through that process, there's still that death benefit that you get, which is a
Mhm.
full value based on what the policy is, correct?
Right. Yeah, so because this is life insurance, whole life insurance is a pretty simple product. I think I talked quite often last time about this, but it's collecting dollars, protecting them from loss, growing them, guaranteed, and dividends, so that it's big enough to hand as a death benefit to your beneficiary one day. So the insurance company, makes a deal with Jared, a contract with Jared, but they're focused on Susan because he said that his beneficiary was Susan. And so they're focused on that. You and I are focused on, you did this thing for the cash side. Eventually you realize, and maybe from the beginning, there's the death benefit side. She's thinking death benefit, right? You have kids. So the insurance company and the beneficiary are very much aligned. but the individual is thinking cash side. And so you're using this cash as it grows over time. If you pass away and there's a loan outstanding, it gets taken off the books and they turn the rest of it into the larger. I don't mean to say that they just ignore it. I'm saying that if you have $1 million death benefit and there's a $100,000 loan, well, now you get $900,000. Right? Okay. So there's always this process with permanent insurance where they take a cash value and turn it into a larger death benefit. There will always be something that passes, even if you're max borrowed against the policy, because there's a death benefit that's larger all the time. Okay? Okay, so just kind of an idea. So I show what I call the not preferred part first. So there's all these kind of doodads. If you're familiar with Robert Kiyosaki language, the doodads, right? The things that don't produce cash flow, right? On the left-hand side, new car, okay, that college is number one asset, that'll produce cash flow, and going on buying an island apparently. So you can use it for whatever you want, anything you want. Right? No one asks you a question. There's no qualification for this loan. It takes a day or two to get it, and they just ask, where do you want us to put it? That's basically the qualification. There's no credit checks or anything. I have clients, never mind, I won't go down that path. I was going to introduce a new term anyway. Okay. So you can borrow and then pay it back on your terms. All right? And when you pay it back, net cash value goes back up. Your actual cash value didn't change, but what is available, if you've made all these loans, now you've collateralized, so there's not much available in cash right now, but your money is still there, right? You didn't take your own money out, right, Brett? Your money's not out, and it's still growing because of that, all right? So, you scare me, by the way, because I heard you're the smartest guy in the room, and I'm all stressed out.
Just a proud father.
So, all right, so payments. You make the payments back. You make them on your terms. When you make the payment, if you make $1 payment back, then it frees up $1 collateral, and you can use it that same day to go do something new with, right? So it brings liquidity back. And so when I was doing this for my real estate, I didn't want down payments in my properties for a couple of reasons. I was worried that some tenant was going to get a lawyer and steal it, because there's a lot of equity in it. So I wanted little equity. I don't even know what that's happened to, but that was my head was. And then I also just wanted my money moving faster. I didn't want my money locked up in the property for the reason that we just looked at with, the whole compounding problem if I put it on the sideline for a few years. So I was, really wanted my money moving. And so one of the things that appealed to me the most was that if I have $1,000 to pay down towards the loan, I get able to use it immediately again, right? My 401k, I borrowed against from my 401k, and so when you borrow $50,000 from your 401k, it's on the sideline, not earning anymore, right? This money still earns. That's why we call it the and asset, while it's being leveraged to do this other thing. And when I pay back my 401k, I had this great idea. Okay, I have a new investment. I got $5,000 out still, so I'm going to pay it back and turn around and borrow $50 because you can't have two loans out at once. Well, I paid it back, and then they said, sorry, 3 months before you can borrow it again. Not true with my policy. So because I got burned on that and lost the investment, I am very appreciative that I can use this repeatedly quickly. So this is what I really like to use it for. I recommend everybody first use it for investments. Why do I say that? Because when you borrow for something that is a cash flowing asset, you got a great idea about how to pay back your loan, right? So you get past that stumbling block of, well, how am I going to pay back the loan and continue to save into my premiums, right, every year? So I think of the premiums as the family savings plan. When I'm talking with clients about, well, what size are we talking about here? Well, I generally save $1,000 a month, or I save $2,000 a year. Whatever it is, I design it for that, for their savings plan, so that it's just repositioning where savings used to be going to where it's now going. And then this loan to the insurance company and back, that's got to be separate money. So, I mean, I think you would agree that if you're saving $2,000 into your 401k and you're just going to reposition that, but you go buy a car, well, how do I refill my account for the next car? Well, that's other money, right? That's separate money. So when you think about repaying a loan, that's not part of the premium. That's a separate discussion, right? And that's why early on I like using cash flowing assets, because it provides the vehicle to repay, right? People ask me, Jay just asked me this today, and well, what do you set up as the repayment plan? Well, first of all, you get to choose, and it's different for every asset. When I did the ATMs, my first payment back is 2 months after I took the loan, and it's $21.25 a month. When I do, one of the mobile home parks, it was 3 months before, or not a mobile home park, an apartment building. It's 3 months of revitalization before they started paying the investors. So I waited 3 months and then started my payment. Rental property that I directly own, I just do it at the beginning of each month because I'm getting the cash flow. Okay, so you get to set those terms, but I like using cash flowing assets as the first few loans because, again, you don't have to come over the stumbling block of, well, how do I pay for that thing, right? Because what happens is the same thing that happened in 2008, which is that everyone was using their home like an ATM machine. We need a new Cadillac. Well, let's just refi the home and pull the money out, right? They never really was planning on paying the money back, and then when the house price went down, they were kind of, swimming naked, as Warren Buffett would say. Okay, so keys to infinite banking. You gotta, this is a little bit of a pitch to work with me. You need to deal with someone who knows what the heck they're doing. And so what that means is, contribute as much towards the cash part, the overfunding. I'm going to show you a picture finally in a moment of what I'm talking about here, but contribute as much as you can to the overfunding part and as little as possible to the basic life insurance policy. And remind me to talk about that, contributions to the base. Minimize expenses and charges, that's part of minimizing the part going to the base. Unlimited access to the funds, uninterrupted compounding. And those are really the keys. Those come with any whole life policy, the bottom two. All right. So, okay, finally, here's what it looks like. So we take a product that's collect, protect, grow dollars, guaranteed, handed to the family. That's the thing on the left. It's been around since the early 1800s. It's been a tax-free vehicle since then. It's worked great. Everyone in America had these things. There was something like 40-some% of Americans of families had life insurance, and there was more than one life insurance policy per American until World War II. Now less than 20% of people even have it, and less than 10% of families have it. There's a lot of work for me to do out there. But it's a product that the wealthy never stopped doing. Like the middle class got really, really caught up in buy term and invest the difference and things like that. When the 401ks came around as our only solution, so we started to learn about stocks and bonds and mutual funds. But the wealthy never stopped doing this. And they also never stopped educating their kids. And so you can see I kind of go back to that because it all ties together. This is a practice that's been around forever, but the number one question I get from people who are in my economic range is, why have I never heard of this? I heard that a couple times today, right? It's because we got a little distracted. But there are portions of society that never forgot it. And there are a lot of people who will say, well, this is only for rich people. Well, it's because That's the cadre who never stopped doing it. So we just kind of think that's just for them. But this can work at any size. Oh, I didn't really talk about that. So the one on the right-hand side is called the overfunding portion, the part in green on top. It's really called paid-up additions. That's the part that's immediately liquid on day one and is flexible on contributions. If you don't want to contribute to that in a given year or a month, you don't have to. And you can often go back and fill it back up in future years when you have liquidity. The thing I got to get right is the bottom, the base, the blue part. That's the part that I need to make the right size so that 2 years from now we're not, having sleepless nights wondering how did we set it so big we can't afford it, right? It's always got to be achievable. I set that right, you and I are happy and have a good relationship forever. Okay, but there's a misconception that the base part is that money you're throwing away like term insurance dollars. It's not. After year 2, in year 3 and beyond, the dollars going towards the base are essentially doing the same thing as the paid-up additions. They show up at a different point in the year, but they're available. The first 2 years, the dollars that go to the base are not available to you for your access. They're held back. It's illiquid. And so in this example, it says 1/3 and 2/3. I typically put like 80% of the money in the green part. So you're going to see like 20% that's not liquid. And that's because it was the base. In the second year, like, darn it, Gary, the same thing just happened. I put 10 grand in and I only got 8 available of that I contributed. And that's because the second year they hold it back too. They grow that just like they're growing your other dollars, but they take the profits from it to overcome their expenses. And then all this stuff starts coming back. And by year 5, maybe 6, there's more in there than you've contributed. But all along the way, you're somewhere between 80 and 100+% liquid and available to use. If it's in cash value, you can use it. You can borrow it, you can withdraw it, surrender the policy, you get it back. It's all there. Jake, is this making sense?
Absolutely.
Okay, so where are the catches? Well, I don't know if these are really catches, but here's some aspects of it. There is a medical qualification. It's not always a medical well, there's some version of it. You got to answer some questions, and a couple of our companies now, if you answer the questions, I don't want to make this sound like we're cheating. If your health is such that the questions come out and they say, we don't even need to look at any doctor's records or do blood, you just get a rating. Often, there will be at least a visit by a nurse for 20 minutes to do a blood check. Or they just want to look at doctor's records. There's government limits on how much you can contribute. We go right smack up against those limits because that's where the efficiency is. And then the proper structuring really is the same thing so that you can get access immediately. The time capitalization is what I was talking about with you got 80% access on day 1, maybe 85, and it takes 5 years to have more than 100% of everything you've contributed available. Okay. This is where I stop, and the numbers are immediately following here if we want to go there. But I want to leave time for some questions. Go ahead.
The cash value, if you die, does the cash value go with? Because, if you're doing 401ks, the money's there, but
Yeah. So there's my great friend Susie Orman says, do you know that the greedy insurance companies keep your cash value when you die? All that your family gets is the death benefit. I say that okay? So here's why they say that. Because if you buy term insurance and invest the difference, you get the difference that was invested. And the illusion there is that you also get the term insurance. 99.5% of people of term insurance policies don't pay out. They're not intended to pay out. They collect pennies on the dollar. They don't collect, protect, and grow enough money to pay out term insurance, except for like 1 in 1,000, or they would go bankrupt. If people with term insurance start dying, insurance companies are going out of business. It's not intended to do that, right? So the illusion there is that you're going to get the death benefit. It is true that when you die by doing buy term and invest the difference in the 401k, you get the part in the 401k, but you don't get the term insurance unless you die at a young age, which thankfully in America doesn't happen often. Does that make sense? So I never answered your question. The answer is yes, the cash value goes away, but it disappears. It's a similar question to when you when you make 360 payments to pay off your home, and you've paid all that money in, when they give you the deed, those greedy bankers do not give back all the contributions you made. And that's the same thing as saying this about cash value. So when your whole life insurance in the 1800s was a process of collecting, protecting, growing dollars and leveraging it up into a bigger amount. So when you die, cash value...
So the cash value goes away, but the death benefit...
Right. There is no death benefit until the day you stop breathing, and the cash value turns into that. Yeah, great question, though. Thanks for bringing that up. I often forget to say that. Anyone else?
Is the 100% of the death benefit tax-free?
Yes. There's one situation, but we don't need to worry about it, where it may not be, but it's a very weird environment of businesses and things like that. But regardless of whether you've messed up and made the cash value no longer tax-free, the death benefit always will be. So there's a thing I didn't talk about, is a red limit here called modified endowment contract limit. This is the one change that the IRS has ever successfully made on life insurance. So the thing about 401ks and Congress's playground is that they own it. They write the rules and they own it. They just need majority, right? But life insurance is state controlled. So life insurance, you got to corral all the different states together to get them in a majority to be able to change the rules. So they did it one time in the 80s, and it's when insurance companies were getting really, really cocky. And they essentially were running full-page ads in the Washington Post, or in the, Wall Street Journal, saying, give us $1 million, we'll pay you $1 million a year, and we'll give your family $1 million, or something like that. And it was huge. It was not $1 million a year, it was $100,000 a year. Give us $1 million, we'll pay you $100,000 a year for the rest of your life, and then we'll give your family $1 million. They could do that in the 15, 18% interest rate world, right, with 12% in savings accounts. But they were getting gutsy, and Congress slapped them. And Congress in 1986 put a limit on that says, we will let you overfund these things, but to a limit, to an extent. They were worried about dynasties. So if you mess that up, then your cash value and your access to it is more like an annuity or a 401k while you're alive. Part of it's taxed. But it never affects the death benefit. Death benefit will never be impacted like that.
So if I took a loan out, or not a loan, but if I got a policy and the death benefit policy was structured for $1 million, and we're saving money over my lifetime, and you get to that red limit, but it's going to continue to grow, correct?
Mm-hmm. Mm-hmm. That's right.
So how does that not get into the red? Even if I stop making premiums, I stop making payments, how does it not get into the red?
The MEC limit is an annual limit that they run on their computers to test, and it has to do with what contributions, so you just put $1 in today of premium, so it's not loan repayment, it's just your out-of-pocket contribution is all that matters.
Yep.
So he sent in this $1,000 check. Okay, so he put $1,000 in today. What's he done the last 7 years? And if combined, that $1,000 tips the whatever that thing is, it's the tipping point. You tip the whatever it is over the teapot, then you've exceeded the MEC limit, and that policy forever is a MEC. Now, it's not that dramatic. They send you letters incessantly for 14 months. They make me say that I've contacted you, and we can reverse the whole thing. But theoretically, it would turn into a MEC at that point. So it's only out-of-pocket contributions, though.
Okay.
So if your policy is bringing in $150,000 a year because you've had it for 50 years and put a lot in initially, and the dividends and the guaranteed increases are huge, then that doesn't impact anything because it's not out of pocket. David?
So the MEC limit has to do with where your premium dollars go when you pay them. It has nothing to do with the cash value growth.
Right. Nothing to do with the growth in the background.
And that's why there's that 2/3, 1/3 illustration there. There's just this esoteric regulation that you can't stuff 99% of your premium dollars into cash value.
Yeah.
You only stuff 70 or 80%. And if you do it higher than that, it's gonna become taxed. It's not gonna have a tax advantage.
Yeah, it's really easy to stay within that limit. Really easy.
It's kind of a scary thing but it's really just the ratio. And if your advisor sets it up right, it's impossible to happen.
Mm-hmm.
Can you touch on a little bit the access to the cash value and distribution methodology later in life and retirement?
Sure. And I don't think I have this other example, but so first of all, you can physically withdraw, you can borrow against the policy, so you can withdraw the money or you can create a loan, right? And people will do both. But as far as let me bring in taxes on this. So I talk about it as a tax advantage. Maybe I said tax-free, but it's a tax advantage. It grows inside tax-free, but it's called tax advantage because there's a way to get taxed on it. And that way would be, when you start withdrawing money from this, it has taxation, which is called first in, first out taxation. Businesses have the same, but no investment really has that. And what it means is that you get to account for a basis, what you've contributed, and then you get the first money that's physically withdrawn. So now I'm not talking about borrowing against, I'm talking about actually withdrawing the money. When you physically withdraw money, don't create a loan, the first money that comes out represents what you put in, a return of your overpaid premiums. So you could have this thing for 50 years, have put $500,000 into it, take out $500,000, all of you put in, had insurance the whole time, they're still going to say that was just excess premium. It's pretty awesome. But that's, so you can withdraw for a period of time, have everything out, and the only thing that's in there is profit, and not paid any taxes. And then if you started withdrawing that, physically, permanently withdrawing it, in your lifetime, it would be taxed just like the earnings that you got on your savings account in a bank. It would be 1099 form. But you can shift to loans, and anytime you're taking loans in retirement, you don't have to pay them back. And typically in that environment, the policy's cash value is growing much faster than you're borrowing. And you just build a loan balance throughout your life. So your cash value is growing, your loan balance is growing, and then when you pass away, they settle the loan, turn the cash value into the large death benefit. So there's no limitations on what you borrow, how much, or withdraw. And people sometimes ask me, well, what rate can I withdraw compared to an annuity? It's pretty close. So, annuities have bad names, but they are the most efficient way to get guaranteed income in this country. No question. When you're in your 70s and above, you want to say, I want $1,000 a month and I want to pay the least amount or contribute the least amount of my resources to it. An immediate annuity is the way to do it. It's got a horrible name because Mr. Fisher said you should hate him. But it's a great product. But life insurance, because they're the same product, ran by the same companies with the same mortality tables or actuarial science, they're really, really close on doing that. Yeah.
Are you going to get into more discussion on capitalization of the plan? David mentioned capitalization. I'm just wondering.
I can show you a number. I can show you an example where you see what's in there compared to what you've contributed. Will that help?
Yeah, I was just wondering, I was thinking a lot of this wouldn't come into play until you put so much into the plan. I'm assuming that 2-year period of time you're talking about, the way that you said that.
Here we go, right here. So first year, $20,000 contributed. In this example, $13,000 available. Like I routinely do $16,000 available in the first year, but this is a conservative approach here. A less lean approach. So then in the second year, you've contributed 40 in this example, and there's 28,000 available. All right, the other money's still there. It was not a fee that went to somebody, but it's held back, not accessible to you, so that they can grow the profits from it and overcome their expenses. In the sixth year in this one, 120 contributed, it's at 120, 144. So this one did what's called break even, greater than 100% available. It took 6 years in this example because it just wasn't quite optimized. Okay, does that help on that? So there's a lot of other numbers there too. And so for you the ones that needed the numbers, they're there. This is a typical illustration. You're going to see the premiums contributed if they never paid a dividend again, and then with today's level of dividend. Today's dividends are extremely low. They're as low as they've had in decades because they typically track a couple percent above what a savings account would do. But this assumes they never pay one. I actually don't look at that column very often, mainly because it hasn't happened 1 year. In this 42-year-old, they're assuming it's going to happen for a good 65 years in a row.
So this is an example that was sent to us if we contact you and say this is what we want to do.
Right. Mm-hmm. But this leading up to this is me looking at your financial questionnaire, me looking at your financial situation and talking to you about what you want to do and what you're capable of doing, and helping make some suggestions after having a chance to look at your financials with you and talk to you about it. Because this one has just a consistent contribution amount every year. This person said, hey, I'm not scared about $10,000 and I'm happy to do 20. So the reason I said this wasn't that efficient is for 10,000 minimum going in, I would be putting 30 maximum into one of these. This is just not quite optimized the way that we would normally do it. Maximize the amount going into the extra cash part, the green, remember? So, but yes, sometimes people want to put a huge amount in at the beginning and very little going forward from there. So I have to first find out what is going to fit your goals and your restrictions, and then figure out what individual in your family is healthy to do this with, and then figure out what insurance company I work with. I work with 12 or 13 companies for that reason, because not every individual's challenge can be solved by one company. So then I find the right company, and then I make some suggestions for you. We kind of go back and forth, and then I send it out. Mm-hmm. Yeah.
Can you talk about the pros and cons of the whole life and paid up additions versus like an IUL chassis?
Yeah, so I stay away from universal life insurance. Indexing is an interesting concept. There's nothing really wrong with indexing. Indexing, you buy options on something. Go ahead.
Explain what I.
Universal? Yeah. So, thank you, David. So, whole life insurance, permanent life insurance. Permanent life insurance is collecting dollars, protecting them from loss, and passing them on as a death benefit. Simple, right? It actually started out with groups like Knights of Columbus passing the hat and collecting money for the widows one day when the husband died. It's the same thing. Collect money, protect it from loss, grow it, have it ready to pay out when it needs to be paid out. In the 70s, term insurance came around, buy term and invest the difference. And people wanted the ability to adjust, have some control and adjust how much money they're putting into their permanent life insurance policies. So a thing which essentially is term insurance with a savings account attached to it was built. And that's called universal life insurance. The challenge with universal life insurance in doing banking like this is that if it's not heavily funded all the time, you lose a lot of the guarantees. So universal life insurance got a really bad name, and so they came out with variable universal life insurance. And that one, instead of just having the investment guy like at a whole life policy invest the dollars in the economy, instead they said, we'll just take your money, we'll put it in the stock market so it'll grow faster. This was the 80s, and everything in the stock market was going well. And then those imploded in the 90s, and they got rid of that idea. So now we have index universal life. Now indexing still kind of has the sexy, we can get you 10% return of the market, but your money's indexed. It's not actually in the market. So like index mutual funds, index annuities, or index life insurance, they're all the same stuff. They kind of buy options, and your money's not in the market. So you're protected from loss, theoretically, right? The problem is the costs in the policies are very expensive, and they can adjust them. There's no guarantee. So the pure idea of life insurance is to push risk to somebody else. It's not likely that I'm going to die, but if it happens to my family, we're bankrupt. But if I die and you're the insurance company and there's thousands of Garys out there and only one of us dies, you're still making tremendous profits, right? Because you pooled the risk and it's not a big deal. So I push that risk to you. The problem with universal life insurance is that if you borrow against the policy, you remove their guarantees that the policy will stay in force. If you reduce your premium, because you get the choice, like that's a fixed premium. You know, you call the whole life insurance people and say, I'd like to reduce that down to $3,000 for a couple of years. It says 50 something, 5504. Like it's got to be that. No, you can't adjust it. So so they will keep the guarantees because you can't adjust those numbers. But with universal life insurance, you can call up and say, I'm having a tough year. I'll pay $500, but I promise I'll raise it again in the future. If you lower below their premium amount, they take away the guarantees that it's going to stay in force. And there's a bunch more. So large fees for indexing, for example. So these are blowing up pretty heavily. And just, David, you said there was an article that came out at the beginning of the month. It's the second of two or three really, really big ones by people not in my industry who have looked at it and said these are financially risky because you can break them and they're expensive. But specifically the reason I stay away from it and Paradigm Life stays away from it, infinite banking people should stay away from it, is because one of the primary reasons you can break a universal life insurance policy is borrow too much against it. You cannot do that with whole life insurance. You can't borrow too much, you can't reduce your premium too much, you can't break it. Does that help? It's very easy to sell though, because I can just say it's going to make 9%.
So the premium's monthly, annual, you can set up quarterly anyway, or is it?
Yeah, you can set up any way you want. Yeah, there's a little bit of an efficiency, but most importantly is what fits your lifestyle, and then long term maybe we shift it to annual. Annual becomes most efficient in the end. Mm-hmm. But yeah, it's flexible. Exactly. Okay, who's dying for a little? What time? I got to be over 35 minutes.
Yeah.
Oh, okay.
We're in the Q&A, so
Okay.
If you want to.
All right. Well, I'm not going to be the one to volunteer just to go into more numbers.
So it's really a 5 to 10 year type strategy for protecting your money and beyond. So for it
Yes.
to really start to catch, some gravity, it's 5 to 7 years out.
Mm-hmm. I've tried to come up with scenarios where somebody has a reasonable approach, I'm trying to come up with a reasonable scenario that's shorter than 5 years long, where you lose. And I just don't, I mean, it would be like 4 more years working in Silicon Valley. I'm going to make $2 million. We're going to buy a sailboat, get rid of all of our possessions, and go to some other island. Like, that probably would mean, if you're really going to do that in 5 years, life insurance doesn't apply here, because you're going to lose out on storing the money in the life insurance. But everyone else in this world has family members that, you know, that the death benefit's going to go to one day. And so most people have longer than a 5-year horizon. You know what I'm saying? It's not about sticking with this investment and then going to another one. It's more like, I'm going to have money in my life for more than 5 years, right? And if you do, you're going to want to save it somewhere. So it does take longer than 5 years, and I've had, you know, it needs to have a horizon of more than 5, but I can't even really fathom anyone who has a horizon less than 5 years of having money in their lives, if that makes sense.
Do you have clients who are doing this for their kids and grandkids?
Absolutely.
Because I'm thinking the time horizon you're talking about, it would benefit quite a bit rather than putting money to 529 or something like that. So I'm just wondering how
Mhm.
that works.
It's very powerful for that. It's powerful for the education side that I didn't talk much about with Legacy. You know, I have a friend who he started his on his 5-year-old son, and his 5-year-old had a bike with training wheels, and all of his friends started getting big boy bikes. And instead of grandma's Christmas money and other stuff going into his savings account, it was going into his bank. And so he said, I want a big boy bike. And they said, well, we've talked about this. You have money, right? And so he had to borrow against his bank. And I'm sure they dumbed it down a little bit, you know, simplified it. But he was doing chores to pay back the money that he got from his bank for his bike. And he said it was amazing, the difference. It was this ownership thing. The first bike was always out in the rain. He didn't value it because it was given to him, right? And this bike was never out. It was never in the garage, right? So it was just an ownership thing. For my kids, like, my oldest is very entrepreneurial focused. I stopped contributing to 529s, and I've had great opportunities to just have conversations with him. He owns a part of a coffee farm with some friends of ours down in Panama, and we had a chance to go visit it. So I'm trying to recapture time, you know, that I got on the farm by using the banking system and financial discussions to do that. It resonates really well with a lot of my clients. It's also, I mean, the policies are going to grow. For somebody who's in their 40s and 50s, it's going to grow better on the children. Somebody in their 30s, it's going to grow just as well on the adults. And it's popular for people to put on their grandchildren as a gift kind of thing. Yeah. One of the limitations is that you just can't do it on a big scale. No matter how creative I get, I can't put more than like $10,000 a year on. It's typically $3,000 or $4,000 on very young children, because that creates, you know, $2 million of life insurance, and it's hard to explain why I would do that. You know, insurance companies are very conservative. They're not going for that.
How hard is it to access if I'm a parent and I have it on a child?
Yeah. So how hard is it to access? So you're the owner of the policy. It doesn't matter beyond that. The owner of the policy has access to everything with life insurance. If you want to hand it to Jay because you liked his shirt, sign it over. So, I mean, my point is you have complete access. You can hand it to your kids one day. You can use the money to go on vacation, whatever you want.
Is there a max on paid-up additions on if the base is $1,000 a year, a relatively low account, and I come across $20,000 and I want to put it in there, is that even possible, or is there a max on that per year?
So that goes back to the MEC limit, and it's generally about 4 to 5 times is really all you can do, and that would only be for a limited number of years.
Okay.
Now, you can go and refill previous years that you didn't completely fill up, or you can pre-stage it for future years earning 3 or 4% in an account. So there are things you can do, but there is a limit to what you can do, and that's really what Congress was trying to do in the 80s.
Sure.
Yep.
So if you wanted to do this for your granddaughter, when she turned 18 or 24 or something like that, to hand that over to her, is that a taxable event?
So CPAs, it's the profit side. So it's minus the basis. The taxable event would be whatever growth is in the policy beyond the basis. And there's ways, if it's worth doing, there's ways to hand that off over a period of time by transferring shares and accounts and things like that, right? So you could do it underneath the gift exclusion rules. Most of the time, it's really not that big a deal. especially if we got a $5 million exclusion in our life, right? You know, we keep that around, not a huge deal.
People in the trust.
Trusts can absolutely own life insurance, yeah. And that's how the family offices do it. That's how the Rockefellers have done it for 6 generations. The trust buys insurance on the newborns. By the time they become 20, they have $1 million in the thing or something, and they use that money throughout the lifetime, and then it replenishes and goes to the next generation. But it goes back to the trust as beneficiary. Trust creates new ones. Yeah. Worn them out?
So Gary, when you were here last time, I said, well, what if you have, this is high cash value life insurance, what if you live a low cash life? You know, what's the smallest number? You know, you put an example up there earlier of the male, 45-year-old male making $150,000 a year. You know, what if you're a 17-year-old male making $24,000 a year? You know,
Right.
do you start it right now, a very small policy, and go, or do you wait till you can afford, you know?
Sure. So if you're going to have savings, if you're going to, you know, so we just get back to the same comments. Well, what's the alternative? Well, I'm going to save money some other location. Is it going to grow like this? Is it going to be as successful? Back to that, you know, those, where are you going to save the foundation? Like, number one recommendation, build a foundation. Well, if I'm going to build a foundation, you know, I'll look at the little grid thing that I had, you know, where's the best place to put it? And making $24,000 a year, the insurance companies won't let me put more than $600,000 of death benefit on him. You as the parent, if he's still living in your home and you had the capacity to do so, you could put $1.5 million on him because you're paying. But they won't let me put a policy in place where the individual has to pay too much. We were just talking about this, you know, your first experience. They won't do that. And they won't let me put too much insurance on an individual. You know, I hear very frequently, hey, I don't want to be cash poor, life insurance poor. Like, put all my money in life insurance. It's actually not possible. They won't do more than 20% of your income. They won't let me do that, which 20% would be pretty substantial. And then I don't want to have too much life insurance on me. That's also not possible. I mean, think about this from an insurance company. You know, will an insurance company, if you have a $300,000 house and you like lighting things on fire, will they give you $1 million coverage on your house? Of course not, right? So they're not going to take somebody whose financial worth, people are worth much more than that, but their financial worth is $2 million and put a $10 million policy on. They just put a bullseye on them, right? So it's not going to happen, and it's not a financial move for them. So you can't be overinsured, and they won't allow me to put policies in place you can't afford. But you can start it at your age, $50, $100 a month, something like that, you know, something that will work. People ask also, the 60-year-olds say this about their 50s, the 50-year-olds say it about their 40s. I wish I had known this 10 years ago, right? And am I too old? I had somebody in their 30s asking. I'm like, I just bought it at 51. And I'm a little nervous about that 51 part, but I just bought life insurance and it made a whole lot of sense in my life. If you've been to a casino, this will resonate, I think. But you walk in and there's a ton of poker tables. It's just like a line that goes, you know, as far as you can see. And the only difference in the poker tables is the initial contribution amount, the minimum bet, right? So it's $2 and then $10 and $100, $1,000, $10,000, invitation only. The rules of poker are the same at every table. The math makes sense at every table. If you have the royal flush, go all in at every table. The difference is you have to play at a different level. So it makes sense in your 80s. It makes sense in your 60s. It makes sense in your 40s. You got to play at a different level in your 80s because there's a minimum amount of life insurance that the insurance companies are interested in doing. Typically, it's a $50,000 whole life policy or a $100,000 whole life policy, and that comes at different costs. Because remember, at your age, they just got to collect. They got a lot of years to collect that money to make it to $100,000, right? To pay it out. At Grandpa's age, they're going to collect larger amounts because they got a shorter runway to collect it, right? It's not that the insurance is that you're shredding the dollars. It's just that you got to play at a steeper level. The money still is we'll look at the numbers, but it still makes more sense than other options for liquid cash.
Gary, can you talk about the initial fees, and then also the fees as on an annual basis?
Most companies have no fees annually, or they have a $100 administrative fee on an annual basis. And there is some, so where do you see costs? Costs they come out of those first 2 years that are held back. Often you'll hear people say the first year of the base premium is cost of, that's fees. The commission to the agent is 100% of the first year. I wish. It's money that money's held back, and it gets distributed to you. But in this example, 5504 is illiquid, and they grow those dollars for 2 years before they give it back, and they distribute that to pay the costs of actuarial science, not actuarial science, of their team, their actuaries, of the medical, if you have to have that done, getting the records, and our services. So everything's wrapped up inside the performance of this. It's all buried inside it. One of the reasons that universal life stuff came around is because people wouldn't accept that. They would not accept that the insurance companies are private companies and won't tell you what their costs are inside these things. I don't know it. I can't give it to you. I just know that it's inside, already resident inside the performance. So when I show you this, and it has a 5% annualized tax advantage, tax-free return, any costs are already inside it. That might not have been satisfying, but I don't know what they are.
One other question, Branch, I'm assuming that eventually this gets to a point where the premium can be paid itself. I'm thinking you start
Yep.
at 6 years
Great.
old,
Self-funding.
and they get 20 years
Yeah.
old, and you stop paying premium.
Mhm.
Everything goes.
Wonderful. Thank you for asking that. So this dividend right here. Okay, so there's a lot of things you can have the dividend do. At the very beginning, we always say have the dividends get reinvested into the cash value as that green paid up addition stuff. The out-of-pocket extra overfunding green part in my picture, the dividend does the same thing as that initially. But you can also have it pay down a loan. You can have it come to you as cash. You get taxed on it, so I don't really like that idea. But there's other things it can do. One of the things it can do is pay the base premium. So when it gets large enough, you can have it just offset the main premium. So there's no longer any out-of-pocket contributions. Typically, in the way they're illustrating today, because of these really low interest rates, that's a few years down the road. It's 10, 12 years down there. That's one way to not pay out-of-pocket. Another way is called reduced and paid up. So what that means is they can downsize the amount of life insurance that's there one time, and then let it grow from there. It's kind of a notch down and then grow. And when you do that, it resizes everything, and all the premiums you've previously paid are gone. You can typically do that after that 7-year point, but you can make the payments go completely away. So both ways stop out-of-pocket contributions, right? No more out-of-pocket. One of them, the costs are still there, or the premium contributions are still there. They're just being funded by the profits. Okay? Great question. David?
So Gary, it's 7:30. I'd like to let people